Hello everyone. Welcome to our deep dive into the fascinating world of options trading. Today we're going to explore a strategy that might sound a bit intimidating at first, but don't worry, we'll break it down step by step. Today we're diving into the world of options trading with a strategy called the short strangle. This strategy is popular among traders who want to generate income in a market that isn't making big moves. Now, don't let the name scare you. The short strangle is actually a straightforward concept once you get the hang of it. It's designed to take advantage of a market that is relatively stable. It's all about making your money work harder for you. By using this strategy, you can potentially earn a steady stream of income without needing the market to make big moves. The short strangle is like renting out a piece of land you don't own yet. You collect rent, we call this premium in the options world, hoping the land doesn't suddenly become super valuable. The idea is to benefit from the stability of the market, just like a landlord benefits from a steady rental income. This strategy is all about generating income when the market is calm, moving sideways without huge swings. It's perfect for those times when the market isn't trending strongly in any direction. Imagine a seesaw that's barely moving up or down. That's a sideways market. In such a market, the short strangle can be a very effective strategy, and that's where the short strangle thrives. It takes advantage of the lack of significant price movement, allowing you to collect premiums while the market remains stable. But remember, just like any investment, there are risks. It's important to understand these risks before diving in. The market can be unpredictable, and sudden movements can impact your strategy. We'll talk about those too, so you can make smart decisions about your money. Stay tuned as we explore the ins and outs of the short strangle, helping you become a more informed and confident trader. Now, why do we love sideways markets for the short strangle? It's a strategy that thrives in calm, stable conditions. When the market isn't making big moves up or down, it creates a perfect environment for this options strategy. Think of it this way. When the market is calm, like a still pond, options prices tend to drop. This is because there's less uncertainty, less fear of big price swings. Just as a serene pond reflects a peaceful environment, a sideways market reflects stability. This is because there's less uncertainty, less fear of big price swings. Investors aren't worried about sudden changes, so they aren't willing to pay as much for options. This drop in options prices is where the opportunity lies. That's where you come in. As a trader, you can take advantage of this calm by selling options. You sell or short options to buyers who are worried about those potential swings. They pay you a premium for the right to buy or sell the underlying asset, like a stock, at a certain price. You sell or short options to buyers who are worried about those potential swings. They pay you a premium for the right to buy or sell the underlying asset, like a stock, at a certain price. This premium is essentially your income for taking on the risk. They pay you a premium for the right to buy or sell the underlying asset, like a stock, at a certain price. You're essentially betting that the market will stay calm and the options you sold will expire worthless. If the market remains stable, the options expire without being exercised. You're essentially betting that the market will stay calm and the options you sold will expire worthless. If that happens, you get to keep the premium as your profit. This strategy works best in a sideways market where prices don't fluctuate much. If that happens, you get to keep the premium as your profit. It's a way to generate income without needing the market to move significantly. It's like collecting rent on a property without the headaches of being a landlord. You get paid for simply holding your position. It's like collecting rent on a property without the headaches of being a landlord. This strategy allows you to benefit from market stability, turning calm periods into profitable opportunities. Here's where we need to talk about the elephant in the room: risk. With the short strangle, your maximum risk is theoretically unlimited. I know, that sounds scary, but let me explain. Remember those options you sold? If the market suddenly makes a big move against you, the options you sold could become very valuable. You might have to buy them back at a much higher price than you sold them for, potentially losing a lot of money. That's why it's crucial to understand the potential downside before entering any trade. Never invest more than you can afford to lose, especially with strategies that carry unlimited risk. Okay, now for the good news, your maximum profit with the short strangle is capped, but it's still a nice chunk of change. Your maximum profit is the premium you receive when you sell the options. You get to keep the entire premium if the options expire worthless. Think of it this way, you're selling insurance to someone worried about their house burning down. They pay you a premium, and as long as their house doesn't burn down within the policy period, you keep the entire premium. Of course, the higher the premium, the greater the risk. It's a balancing act, and it's essential to find a risk-reward ratio you're comfortable with. Now let's weigh the pros and cons of the short strangle. Advantages: income generation. This strategy is all about generating income in sideways markets. High probability of profit. When done correctly, the short strangle has a high probability of success. Flexibility. You can adjust the strategy to fit your risk tolerance and market outlook. Disadvantages: unlimited risk. The potential for loss is unlimited if the market moves sharply against you. Limited profit potential. Your maximum profit is capped at the premium received. Requires active management. This strategy is not for passive investors. You need to monitor your positions and make adjustments as needed. As you can see, the short strangle can be a powerful tool for experienced options traders, but it's not without risks. Let's say you believe Unilever, ticker symbol UL, stock will trade within a specific range for the next month. Unilever is currently trading at $50 per share. You decide to sell a call option with a strike price of $55, meaning the buyer can buy Unilever at $55, and sell a put option with a strike price of $45, meaning the buyer can sell Unilever at $45, both expiring in 1 month. For selling these options, you collect a premium of, let's say, $2 per share. If Unilever stays within the $45 to $55 range for the next month, both options expire worthless, and you get to keep the entire $2 premium per share as your profit. To enter a short strangle, you need a brokerage account approved for options trading. You'll need to choose your desired stock, which involves researching and analyzing various stocks to determine which one fits your strategy. Look at factors such as the stock's volatility, historical performance, and upcoming events that might affect its price. Select the appropriate strike prices for your options. This step is crucial as it determines the potential profit and risk of your trade. The strike prices should be chosen based on your market outlook and risk tolerance. Then place a sell to open order for both the call and put options. This means you are selling the options to open a new position, and you will receive a premium for each option sold. Exiting the trade can be done in a few ways. It's important to monitor your positions regularly and be prepared to act based on market conditions. You can wait for expiration. If the options expire worthless, you automatically keep the premium. This is the best-case scenario for a short strangle, as it means the stock price stayed within the range you anticipated. You can buy back the options. This involves purchasing the same options you sold to close your position. You might do this to lock in profits if the options have decreased in value, or to limit potential losses if the trade is going against you, or you can roll the options. Rolling involves closing your current position and opening a new one with a later expiration date. This can be useful if you want to extend the duration of your trade and potentially increase your profit. It's important to have a plan for exiting the trade before entering, as this will help you manage your risk effectively. Consider different scenarios and decide in advance how you will respond to each. This proactive approach can help you stay disciplined and make more informed decisions. Before you even think about trying the short strangle, remember this: options trading is not for beginners. It requires knowledge, experience, and a high tolerance for risk. I urge you to seek advice from a qualified financial advisor before making any investment decisions, or read about them in detail. My book is available at Amazon. I will put a link in the description. They can help you understand the risks and rewards involved and create a trading plan that aligns with your financial goals. Remember, knowledge is power. The more you know about options trading, the better equipped you'll be to make informed decisions about your money. The short strangle can be a powerful strategy for generating income in sideways markets, but it's not for everyone. It requires careful planning, active management, and a thorough understanding of the risks involved. If you're considering adding the short strangle to your trading arsenal, make sure you fully understand how it works, the potential risks and rewards, and whether it aligns with your overall investment strategy. And as always, never invest more than you can afford to lose. Remember, the best investment you can make is in yourself. Educate yourself about personal finance, make informed decisions that will help you achieve your financial goals. Thanks for watching and see you next time.